let's go back to where we were just before the break, and we did practice holding hands during the break. We've decided amongst the three of us we're not going to do it ever again. How do you forge that partnership between the venture capitalist and the entrepreneur?
Sure. There are a number of elements to that, and there's no one magic recipe. But it's important to understand how the private equity fund manager or the venture capital fund manager is incentivized. So they raise a fund. They have to put their own money into that fund as well. They then go and seek investments that they look to invest into. And they make a return after they've returned a specific amount of capital to the original investors. So they're positively incentivized to work with the entrepreneurs to make that a success. As I said, to buy something for 100, work with it and sell it for 400 or 500 over a period of time, because that's how they make money as well. So they share in the profits, but they haven't necessarily put the complete amount of capital at risk. Mm-hmm. So with that in mind, there's a very close relationship that is set up between the entrepreneur and the fund manager. And as Mike mentions, there's regular interactions in terms of understanding where the business is at, getting the corporate governance right, and that understanding what is the strategy, how are we going to grow this business, what acquisition opportunities are available, where should we be looking to focus in different type of markets and the like. So there's no one specific type of recipe, but there's definitely a very close relationship that gets forged between the financier, the venture capital or private equity fund manager, and the entrepreneur.
How do then on the flip side, how do you get involved in this? If you're not wanting to access the money, you've got spare money, how do you put it into a pot to create something that people can come to and you can look at their business? Because I believe that something like 2% of the people who come to private equity firms are actually taken on. It's something as low as that.
I would say it's probably easy around that. Yeah,
correct.
I mean, I think for every 100 business plans we get, probably I would say 95 would probably end up in the bin, in the trash.
Yeah,
unfortunately.
Okay, how do you then make that money? Where do you guys get your money?
Where do we get money? I think there's two types of funds in South Africa. I think you've got the on-balance sheet funds, like an RMB Corvest, where all our money is actually on balance sheet. It belongs to RMB, which is part of the First Rand Group. Then you've got the second one, which is third-party money, which is guys like the groups Ethos, Brait, Actis, and what they do is they go out in the market, either South Africa or internationally, and they raise those funds. And the management then would have an agreement or a carry to invest those funds on behalf of third parties. And that's typically where...
That's a bit riskier then, surely, isn't it?
It's really both the same. I mean, the investment philosophy of both are exactly the same. So either the funds are coming through the banks, local institutions, or they're coming from third parties.
And Jeremy, if you look at the analysis that we do on an annual basis, you'll find that the vast majority of those types of investors are institutional investors or very high net worth individuals. There's not necessarily a lot of retail product offerings for private equity. So the proverbial man in the street that can go and give 50,000 Rand to a fund manager and say, go and manage that money on my behalf. There are some retail products, but because the numbers involved are relatively large, even on the smaller VC side, it's 500,000 Rand up to 20,000 Rand VC investments that we've seen. Therefore, the check size is quite big, and they don't want to go and manage thousands and thousands of 50 Rand or 50,000 Rand pockets, because it becomes very cumbersome and expensive to do. So intuitively, the asset class, both locally and internationally, is more institutionally driven and really high net worth individually driven.
When you say high net worth individual, what are you talking about here?
I'm saying north of 50 million Rand, personal NAV type of numbers.
Yeah.
I think, Jeremy, if you lessen that, quite honestly, this is not a product for the man in the street who has got a pension that wants to now allocate it to private equity. I think this is risk capital. We don't get equity, we don't get security when we invest. So by nature, private equity is also cash flow lending. So it is up the curve.
But now, hang on. Surely then, this should be there should be a gap in the market here for a listing on an exchange where you could buy shares, for example.
Yep.
And those exist.
Do they?
So Basilius Capital listed middle of December last year, which is again through a preference share type of structure. So those exist. They also formalize networks of high net worth individuals that maybe not at the 50 million Rand mark, but collectively pooled.
Like you guys.
Not me, definitely. You should see what car I've arrived in. That have pooled capital and then syndicate that investment. So there are formalized business angel networks that are starting to crop up in South Africa, looking to do early stage investments and the likes. But to Mike's point, by and large, it's risk capital. If anything, and even if you look at the Pension Funds Control Act, that then stipulates the amount of capital that a pension fund can invest into different asset classes, they only say that collectively for hedge funds and private equity funds, 10% is the number. So, and if you filter that down to an individual, then your risk appetite for this type of thing will be a really small slither of your portfolio.
Okay, so basically what we're saying is to the general viewer of this show, you're not going to be involved in that side of it at all.
Unlikely.
Yeah.
I think it's difficult.
So we are now then addressing the people who are wanting to access that money.
Yeah.
It's difficult. You've got to have a damn good business plan.
Yeah.
What do you guys look at? When you get a business plan, what do you look at? There must be certain things that...
I think the number one thing we look at is management. Very difficult on a business plan, but I think you can get the sense of the experience and the competency of that management team. So for us, it's a partnership. You're getting into bed with guys here for sometimes 2 years, sometimes 20 years. We've got some investments in our portfolio that we've been in for 22 years. Now, if you're not going to get on with that management team, seeing them monthly at board meetings and strategy meetings and various committees, you're going to have a major problem. So for us, it's about management, have an understanding where they're going and what we want out of the deal. But I think also looking at the numbers. Obviously we are all historically focused on financial people, and the business has to have the right sort of credentials in terms of starting at a right capital base, and with obviously growth potential.
But hang on, I thought the whole thing about private equity was that you buggers bought something at a decent price and then built it up, helping the person who had it in the original place and then selling it. What are you talking about 22 years now? You know what? That's a marriage, for goodness sake.
It's longer than most marriages in South Africa.
Exactly.
So I think the normal route is obviously 5 to 7 years. If you ask any private equity player, you would like to be in and out 5 to 7 years. Return the capital back to your shareholder base and then reinvest that into other growth opportunities. Quite honestly, in South Africa, where you don't have the number of deals that you do internationally, and you find good businesses and good platforms to start building, why sell out? For us, getting into some of the groups like the old Fidelity Group many years ago, we found the cash flows were very good, the dividends were very good, and the management was first class.
Be nice, you see.
Why sell?
You nearly stumbled there, didn't you? And nearly lost a private equity partner.
But really, in those instances where you're making good returns and the company carries on growing, it's all about growth. As long as the company has got the ability to carry on growing, why would you want to sell out of that investment? Where you see it sort of plateauing and you think at certain stages, there's stages of private equity where it makes sense to sell. Suddenly the growth starts slowing down, it's maybe time for another partner to take it to the next level, or it could be an IPO in the market, or management comes back to you and says, we want to own this business ourselves. Those instances you would sell out. But where you really are making fantastic returns and it carries on growing, on an on-balance sheet funder like ourselves, we would obviously look to hold that for an indefinite period. But it's, again, Jeremy, as you say, it's about the return. Yeah. If someone approached us or we looked at the market and thought we could make a good return, we would obviously sell out.
From a SAVCA point of view, what is your role in all of this? If I, the original inventor of the overhead combangulator, came to you, could I come to you and say, look, this is what I've got. Do you have any... Would you be able to point me in the right direction?
It's definitely not our primary role. Our primary role is to serve our membership like Mike and service and lobby for reforms in relation for private equity fund managers. But
so Mike and the Oaks pay you?
Yes, they pay us membership fees.
Obviously not so much because you just said you're not driving a decent car.
I don't have the 50 million NAV.
Yeah.
But to your point, Jeremy, so it's not our core function, but yes, we're most definitely willing to help and are able to help because we know our members quite well. We've got a pretty decent website where there's a matrix of all of our various members where you can go and see what type of high-level investment preferences each of our members has and whether or not you would meet their profile or their investment mandate. To build on Mike's point, yes, it's definitely around management, experience, entry multiples, risk, exit, the product growth strategy, and the likes. Those would be important elements that the entrepreneur needs to bear in mind. And put yourself in the shoes of the bank manager or the person that was going to write you a check, and unpack your business from a clinical point of view as to, okay, where are these risk elements, and try and build a relationship with these people.
But now, we're fast running out of time, but almost in closing, it's all very well to say that, but you're talking about an entrepreneur here in most cases. Entrepreneurs usually see the bigger picture and they go, you will not believe what this overhead combungulate is going to do. And they can't be clinical because they're passionate.
It's a fine balance. It's an absolutely fine balance. I've never seen, and I'm sure Mike has never seen, any business plan proposal where the graphs don't go like this. It just doesn't happen, right? No one's going to come and sell that anyway. But I've yet to see a business that has met those projections spot on for 3 years going forward.
So you've got to take it down. You've got to ratchet it down and say, right, let's be realistic.
Yep.
And let's bring the bank to bear here and be bankers and look to the downside instead of the upside, as the rest of us jolly happy people do.
And I think it becomes easy. When you're looking at 100 business plans, for instance, when you meet that management team that has got a concept, has got an idea that they're now going to roll out to the rest of Africa, for instance, you will pick that up very quickly. You'll see their passion, and you'll just see it in the way they've run their current business. You'll pick it up very quickly. And that's obviously what private equity guys are looking at.